Okay, before we head in, just a few announcements. CFA Level 2 candidates, your exam starts this week. The May exam window starts this week. So we're going to have an office hours blitz Monday and Tuesday on Discord. If you are a markmeldrum.com sub, we don't have a site called mm.com. It's markmeldrum.com. Just for shortcut reasons, I put mm.com. So please don't email me saying I typed in mm.com and I got nowhere. It's just shortcut. If you're a subscriber to our CFA product already, the link for Discord is already on the site. If you're not a subscriber, but you are going to be sitting for the level 2 exam, that's fine. You can attend these office hour sessions. Go to markmeldrum.com, set up a free account. Once you set up a free account, you're going to see a folder for some level 2 free material. There's not much there. Honestly, there's not much there. But if you click on that, then you will find the link for Discord. Same with on the site. If you're a subscriber and you're wondering where it is, just click on any folder. Let's say that you want to watch Quant. Click on Quant, and you'll get the list of videos up. And right over here on this side here, you'll see the link for Discord. If you're going to get a role, like once you click the link and you go to Discord, you're just a member. You can't see anything. You're in a waiting room. I have to assign you a role so that you can attend the level 2 special event. To get a role, I need you there before 9 a.m. Monday morning. So if you're going to show up at like Monday at 2:30 in the afternoon, I probably won't get to you, right? I won't be able to assign you a role, which means you'll miss it. So if you want to attend these office hour sessions, if you have any questions outstanding about level 2, about the content, about understanding something, this is where you want to be. You need to get there before 9 a.m. Monday morning, okay? Make it easy for me, which makes it easy for you. Get there Monday before 9. Sorry. For applied analysis, I should explain. I got sick. Most of you know I got sick in Italy, and I still have the trail end of this. I don't know what it is, but I just can't shake it, so sorry for the coughing. Applied analysis, this will be up Monday. There'll be a video for an introduction to LLMs. You should know how these things are built and how they make decisions. I shouldn't say make decisions. They don't really make decisions. I'll explain that. Once we know how they do things, we can then start talking to them a little bit better. Then I'll follow that up with an introduction to reasoning models. So you have large language models, and then on top of that you have reasoning models. These are called foundational models. On top of that, you can then build domain-specific LLMs, and a lot of domain-specific ones are built off of these foundational models, so we should understand these. And then we'll do some financial analysis using Peabody-Cole's annual reports, and we'll do that in Notebook LM. And again, wow, the information that you can get out of it. And Notebook LM, when you give it its sources, won't go outside of that. It uses the Gemini 2.5 Flash model, which is its reasoning model. So it does a really good job with this stuff. But we'll put it in Notebook LM. We'll do about 4 or 5 years, which each year has like, what do you got, 3 years of balance sheet, 2 years of balance sheets, 3 years income statements in here. And then we'll use Flash, and we'll ask it some questions, just enough so that you can see the pattern, and from there you can continue on. That means that you can take any company's 10Ks, stick them in there, and do what we're about to do on Monday with Peabody. Okay, let's head in. We'll begin this week with inflation data. We had both CPI and PPI, and both of them came in quite low, although CPI did inch up from last month. We are now running, I think, 4 months in a row with the Supercore below the Fed's target. Now, mind you, that is CPI, it's not PCE. They look at PCE. We'll get that near the end of the month. The next FOMC, June 18th, we will have a PCE, a jobs report, and a CPI before that. We'll also have our second look at first quarter GDP. I personally think the Fed had permission to cut at this last meeting. I think what messed it up was the meddling from the White House. The president advocating for a rate cut and calling the Fed chair names. Had they cut, the market might have seen that as political, and the outcome might have been worse had they not cut. So that was an error, and I think you got to give the error to the administration on that one, not to Powell. But I think it was a mistake not to cut, and I think that will only become clear in time. Let's have a look at what we have. Anything with a red dot is a negative, which means deflationary. So we have our headline month over month 0.221. I'm not going to use these numbers because only one decimal place, 0.221. Year over year 2.31%. Their target on PCE is 2% over the long term, which means if this is the 2% line, this is what they look for. You know, over the long term, that's above 2%, that's below 2%, but this should not incite them to do anything within a particular range. Usually the range is 1 to 3%. At least the Bank of Canada uses a 1 to 3% range. That at the 1% level, you start to get concerned about deflation. At the 3% level, you start to get concerned about inflation. We're well within those bands that if we were at 2% and over the last couple of months we had risen to 2.3% year over year, there would be no action from the Fed about raising rates. So I think they're suffering from the recency effect as they remember 9% inflation and they say, oh my God, we got to get this down. We have to absolutely kill this monster. Well, this monster's not a monster anymore. It's just a little puppy dog. The core, 0.237 month over month, 2.78% year over year. That's probably what they're more interested in. However, housing has a lag. So if we look at Supercore, 1.78% year over year inflation. They're not capturing, the CPI is not capturing actual market rents right now because it imputes a lot of that owner's equivalent rent. So it imputes it as opposed to looking at real market data, and rents are under pressure. That's, I think, the fourth month in a row that Supercore has been below 2%. If we look at the last, let's go from February to April, all items 0.2, negative 0.1, 0.2, all within a decent range. All items less food and energy, 0.2, 0.1, 0.2. And if we look at services, less energy services, 0.3 to 0.1. This is now back to 0.3. This is services, less energy services. Let's look at PPI, final demand for goods. This is the opposite side of PPI. CPI is what the consumer pays, and PPI for final demand now. There's two sets of indices. There's final demand and then there's intermediate goods. Intermediate goods is the price pressure within the supply chain all the way to the producer. This final demand goods, final demand services is what producers are receiving for their products or services, whether it comes from the consumer or whether it comes from an insurance company or whether it comes from government. It's what they receive. Have a look at total on goods, 0. Although the core, 0.4, that's a bit elevated, is the core. Services, though, negative 0.7 with margins taking the biggest hit, negative 1.6. It's sort of suggesting a reluctance to raise prices and to absorb any increase in prices through tariffs, because there are tariffs that are already ongoing. We'll talk about that shortly. Negative 1.6 margins. So if we do have these margins that are being constricted, it is consistent with earnings estimates coming down. I don't know how you continually suggest we should trade for a higher and higher multiple on lower and lower earnings. We will bring up Walmart shortly. Walmart this past week warned that they're going to have to increase prices. And the thinking goes that if Walmart can't absorb it, because they have a very efficient logistics system, if they can't find a way to absorb it because they're the king at that, what are other companies going to do? President Trump in response to that said, how dare they blame the tariffs for this? They've made billions and billions of dollars. They should eat the tariff. They should eat it. I'm watching and your customers are watching. And we know that Trump has used the power of his office to punish companies and people who don't toe the party line. So he's openly advocating for lower profitability for Walmart because of this, while at the same time telling you the stock market's about to take off. Well, which one is it? Right? If you are going to begin to punish companies that raise prices because of tariffs, and you're demanding that they eat the tariff and have lower margins, then that's going to lead to lower stock prices for those particular companies. Headline, year over year, 2.4, core 2.9. Our effective federal funds rate right now is 4.33%. Look at these, are we restrictive at 4.33%? Well, even looking at the core, 2.78, it's above core. Super core, 1.78. So in terms of super core, you're really restrictive. Even PPI core, you are restrictive roughly by about 130 to 150 basis points restrictive. That's very restrictive policy. You've got the Fed funds rate above the rate of inflation. January ZQ, which is the Fed funds future, sitting at 96.21, pricing in 3.79% on the Fed funds rate as of December 31st, because there's no meeting in January. So this would be the average rate all through January. That's 54 basis points. That is consistent with the SEP. That is only 2 cuts from now to the end of the year. It's pricing in exactly what the SEP says. I think they have permission, more than enough permission, to cut in June. They are paying attention to tariffs. This will not be continuing price pressure. However, the U.S. is roughly a $30 trillion economy. Imports are about $4 trillion, and with the carve-outs, only about $3.2 trillion are facing tariffs, and there's 10% on all of that, and of course there's 25% on auto parts and autos that are not USMCA compliant or made in the U.S., and steel and aluminum. So overall, you're talking about 10% of the U.S. economy is going to have some pricing pressure, right? So even if you say 15% on average, blend it all and say 15% on average of the 3.2 trillion, that's a far cry from pricing pressure, general pricing pressure on 30 trillion. And what is being ignored is the deflationary effect of technology, which is accelerating, especially in the artificial intelligence field, in the large learning models and the reasoning models. I don't know that the media paid enough attention this week to Microsoft's announcement of a 3% headcount across its organization, 10,000 people, primarily in software engineering and coding. Now, Microsoft didn't say it was a result of AI, but read between the lines, right? A couple other companies have also announced layoffs, sizable enough to pay attention to, but we seem to be ignoring, or the Fed seems to be ignoring all of that, which is happening every single day, but paying attention to tariffs, which are only on roughly, if there's no change in imports, 3.2 trillion of imports, and only paying attention to that when the effective federal funds rate is already running about 150 basis points above even the higher reading, 2.9. You're 143 basis points above the 2.9. You are already very, very restrictive. You've got 3 months in a row of rather benign month-over-month inflation. 4 months where the supercore and CPI is below 2%, you had a negative reading on GDP for the first quarter, and you have very real deflationary pressure from AI going forward. It's only going to accelerate. Why are we 150 basis points restrictive? I mean, you can cut at every single meeting this year. And get your Fed funds rate probably still slightly above where I think inflation will be by the end of the year. I seem to think that there's permission here to cut, but the market doesn't. So because of that, I will explain my new positions on ZQ. I was long ZQ. ZQ paid off really nice and now has come right back down to pricing in two cuts for the end of the year. That's the SEP. I think you'll get 2 cuts. I think that's the baseline. In which case, if you take a long position in ZQ that is pricing in 2 cuts, you can't lose because, well, that have to only be 1 cut or no cuts. I just don't see it. Given the inflation data, given the GDP data, given the growing announcements of layoffs because of, air quotes here, rationalization, translation, hey, look, AI is allowing us to do this. If you don't start cutting, I think that's going to be a big problem. Now, with the downgrade that we got Friday after the market close, yields are set to open higher when we open on Tuesday. Yields are set to open higher, which means higher borrowing costs. There is only one market to pay attention to in the U.S. The administration right now seems highly focused on the stock market. It's the wrong market. It's not going to save them. The bond market will destroy them. They need to pay attention to the bond market. Let's look at the press release from Moody's. This came out after 4 o'clock on Friday. So when we look at our numbers week over week, I'll give you 2 returns. Return week over week for an index at 4 o'clock. And then after hours, because I'll show you a chart of the S&P in a second here. Moody's downgraded Government of the United States, a long-term issuer, and senior unsecured rating to AA1 from AAA. Changed the outlook to stable from negative. So it was AAA negative, downgraded to AA1, and at that point, the outlook is stable. 1-notch downgrade to our 21-notch rating scale reflects the increase over more than a decade in government debt and interest payment ratios to levels that are significantly higher than similar rated sovereigns. Successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest costs. We do not believe the material multi-year reductions in mandatory spending and deficits will result from current fiscal proposals under consideration. Over the next decade, we expect larger deficits as entitlement spending rises while government revenue remains broadly flat. That's a bold statement. Government revenue remains broadly flat. I don't know that I would agree with that. You are going to get revenue from tariffs because it is a tax on your own citizens. You are going to get revenue from tariffs. Can you keep that revenue, or are you going to have to give it as aid to certain industries like you did the last time you raised tariffs? Most of that money went to farmers. Are you going to have to give it away and thus not have the income? If the U.S. economy grows, even at 2% a year, that means government revenues grow at 2% a year if you keep the tax haul constant, let's say at 17% of GDP. If you can get 2.2% growth, you're getting growing revenues. If you get 2.5% growth over the next 10 years, you have growing revenues. You don't need higher tax rates, you just need a higher tax base. So I don't know that I would agree with this remains broadly flat. In turn, persistent large fiscal deficits will drive the government's debt and interest burden higher. That's the problem. The big problem right now is the interest cost, or it's going to be a big problem. You've got to get the long end of that curve down now. Never mind about the stock market. Never mind about who's passing on tariff costs or whatever the case is. Never mind any of that. There is only one market in the U.S. that matters for the success of that nation today, and that is the bond market, the Treasury market, and it's the elevation on the yield curve. You got to get that down. Your debt is simply too big for those levels. And again, we're set to open on the long end of the curve at least 9 basis points higher on Tuesday. U.S.'s fiscal performance is likely to deteriorate relative to its own past and compared to other highly rated sovereigns. Stable outlook reflects balanced risks at AA1. U.S. retains exceptional credit strength, such as the size, resilience, and dynamism of its economy and the role of the U.S. dollar as global reserve currency. In addition, while recent months have been characterized by a degree of policy uncertainty, we expect the U.S. will continue its long history of very effective monetary policy. Ooh, slap in the face to the fiscal people. Even though it's being characterized by a degree of policy uncertainty, the Fed, these are the adults here. Its long history of very effective monetary policy led by an independent Federal Reserve, comma, for now. I don't think Moody's got the memo. Every time you make a statement like that, that involves the administration, you must end the sentence with comma, for now. The stable outlook also takes into account institutional features, including the constitutional separation of powers among the 3 branches of government, comma, for now, that contributes to policy effectiveness over time and is relatively insensitive to events over a short period of time. With these institutional arrangements can be tested at times, we expect them to remain strong and resilient. Okay. U.S.'s long-term local currency and foreign currency country ceilings remain at AAA. AAA local currency ceiling reflects a small government footprint in the economy, extremely low risk of currency and balance of payments crisis. I agree with that. We don't need to read the rest of that. Rationale for the downgrade. This is interesting. Over more than a decade, U.S. federal debt has risen sharply due to continuous fiscal deficits. That's a statement of fact. During that time, federal spending has increased while tax cuts have reduced government revenues. Statement of fact. As deficits and debt have grown and interest rates have risen, interest payments on government debt have increased markedly. Statement of fact. It's a good paragraph. Without adjustments to taxation and spending, we expect budget flexibility to remain limited, with mandatory spending, including interest expense, projected to rise to around 78% of total spending by 2035, from about 73% in 2024. If the 2017 Tax Cuts and Jobs Act is extended, which is our base case, which I think is everyone's base case at this point, it will add around $4 trillion to the federal fiscal primary deficit over the next decade, about $400 billion a year, assuming that you can't get any offsets. This is just the spending, never mind the revenue part. Assuming that you can't make cuts anywhere else. It failed in Congress, or it failed, I think, to get out of committee. Typically, the Democrats are saying this goes too far. This goes too far. Okay, well, they don't matter. It goes too far, who cares? But you have some Republicans saying it does not go far enough. You have to cut entitlements. You have to make some big cuts there. And I think he's right. If you can solve the yield curve problem, if the administration can all turn its focus, everybody turn its focus to the long end of the yield curve, you can solve a lot of problems on the long end of the yield curve. If you can get that down 100 basis points, it is a cut right there in the interest expense that you'll have over the next 10 years, because you're going to start floating debt later this year. At the 10-year, at the 20-year, at the 30-year, you're locking in that interest expense for the next 10 years. You got to get it down. It's got to come down. As a result, we expect federal deficits to widen, reaching nearly 9% of GDP by 2035. Stop right there. 9%. That is unsustainable. That by 2035, if you continue on that path, you get to 2035, there will have been many more downgrades to U.S. debt by the time you get to that point. So this is not just we'll revisit it in 2035. By 2035, U.S. debt may be, you run the likelihood, if this is true, of probably most companies in the S&P 500 having a higher credit rating than the U.S. government, with a credit spread, but still having a higher credit rating than the U.S. government. Maybe even having cheaper debt. You'd probably be more willing to buy $1 million of bonds from Apple than you would from the U.S. government. If you continue on with this, 9%, up from 6.4% in 2024. And we know for the first 6 months of this fiscal year, the budget deficit is even wider than it was last year, driven mainly by increased interest payments on debt, rising entitlement spending, and relatively low revenue generation. Extending all of the tax cuts, no tax on tips, no tax on overtime, no tax on Social Security under a certain value. You've got to cut some of these entitlements. The revenue from tariffs are not going to do it. However, I do think that 10% across the board will be a distant memory in a couple of months. That's not going to stay at 10%. You have a market that has rallied all the way back, almost all the way back, and the administration sees this saying, see, they took the 10% and look where we are. They want to go to all-time highs. So they can handle more than 10. They can handle 15. They can handle 20. I would look for more of that to happen. But Moody's is right here. If nothing changes, you're reaching 9% by 2035. That is unacceptable. We anticipate the federal debt burden will rise to about 134% of GDP by 2035 compared to 98% in 2024. Where are they getting the 98%? They are taking out from the debt the amount that the Fed is holding, because that is just owed all to itself. So all the stuff that it owes to itself, it's taking out and just looking at what's external to itself, 98%, 134%. Now, Japan has much more, but Japan's borrowing costs are really, really low. It pushed that yield curve all the way down, really low. I think that's where the U.S. has to head. And I do think they have permission to go there. They have permission, but long end of the curve is market determined. Despite high demand for U.S. Treasury assets, higher Treasury yields since 2021 have contributed to decline in debt affordability. Statement of fact. Federal interest payments are likely to absorb around 30% of revenue by 2035, up from about 18% in 2024, 9% in 2021. You have doubled it, 9% to 18% in 3 years. And going from 18 to 30 over the next 11 years, 30% of all revenue. You see how that is the threat right now. One market only. U.S. general government interest burden, which takes into account federal, state, and local, absorbed 12% of revenue in 2024 compared to 1.6% for AAA rated sovereigns. Look at the difference, 12% versus 1.6. So Moody's is making the case that, look, the U.S. is still probably the best place to lend money to. The U.S. government's probably still the best place to lend money to, but we have other sovereign governments with AAA, which with much better statistics than this, so they just don't deserve to be AAA based on what other AAAs look like, but they're still probably one of the best countries to lend money to. Rationale for the stable outlook. This is where they talk about the rationale for the stable outlook. Let's have a look at what happened to S&P after hours. Let's move that off the screen. There's 4 p.m. Finished at 594.30. Officially in a bull market. NASDAQ's in a bull market. I think almost every index now is in a bull market. We're in a bull market. There's the downgrade. Bang. And then it continued to slide all the way into 8 o'clock. Ended at 588.25. Just under bull market territory. That's $6.05 lost on that. Translates to roughly about 60 points on futures, but this happened after hours. So you didn't really have a lot of the volume that was in there. So the question becomes, was it too much because the volume was light and it moved the market a lot? Or did a lot of people miss it altogether, and by the time they got home, looked at it and said, I can't believe that. Is it not enough? We won't find out. It's Sunday now at 9:32, but we have a holiday on Monday. Futures will be open tonight. Currencies around the world will be open tonight. North America's closed on Monday. We won't really see the effect till Tuesday because, of course, the market has time to digest this and think about this and read research notes, and brokers will be sending those out to clients about, what we do, hold the line, positioning, this kind of stuff. And we'll see what the real reaction is on Tuesday morning. But I expect that by 6 o'clock when we open for Globex, that we are going to open red. Where it goes from there, who knows? This is, we've had downgrades before, but this is now the last of the AAAs are gone. There is no rating agency now that holds the U.S. still at a AAA. That's the last of the AAAs. They're gone. So we have this. So because of this, when I look at how we did SPY week over week, I will use the closing price at 4 o'clock and the closing price at 8 o'clock because this is a real thing. To use this is to ignore the fact that this actually happened and is going to have an effect. Okay, what we're seeing here are yields and rates without the effect of the downgrade. The markets were closed. These rates are in the history books without the aftermarket effect. But we can look at the move in TLT and we can use its effective duration and move backwards to what we think would be, because they hold average maturity of about 25 years, what we think would be the rise in basis points on the long end of the curve after market. I'm going to show you that on the next screen. It's about 9 more basis points. So instead of these being up 6, we could say that they were up 15, each of them up 15. So they are significantly higher. It's where the 10-year is going to go. Does the 10-year go up 9 as well? If so, we cross that 450. Anything under 450 is, hold your breath and hope for the best. And let's see if we can hold under 450. The longer we hold, the more momentum we might have down to 4. But above 450 seems to be a pivot point. 5 becomes in view. And we have the all-time high, or the cycle high here, from October 19th, 2023 of 4.98. What does this do, right? 91% on nothing happening in March 18th, 8.3 on 25. I seem to think they're good to go here, and I seem to think they should. Not only should they should do 50 to make up for the 25 that they should have done, but I think they're good to go. We got a lot of open mouth operations this week. Monday, you got 5. Tuesday, you got 7. And you got 1, 1, 1. And then Sunday, next Sunday, Powell is talking. That doesn't affect anything up to Friday, but then Powell is talking. There might be a lot of graduation ceremonies going on, and some of these may be convocation speeches, because there are a lot of people talking. Upward sloping 2 to the 10 still, Canada and the US, upward sloping. Canada more so on the money market, the capital market, but still flirting with the zero line in the US. What do we have coming up this week? Canadian CPI in 2 days. GDP and CPI for Mexico in 4 days. PPI for Canada in 4 days. And Canadian retail sales in 5 days. Nothing exciting on the economic front for the four days next week. And on earnings, nothing really that interesting. So I think this downgrade will dominate the theme next week. And maybe some of this Fed speak leaks into the market as well. Is the market going to shrug this off and continue its march upwards? If it does, it emboldens the administration to say we can do more than 10% tariffs. They're still trying to get their budget bill out of committee for Monday. Maybe Trump on the phone is saying, look, we're going to go higher on the tariffs. Look at where the market is. Everybody's fine. We're going to go to 20%. We're going to get the extra revenue here. You haven't accounted for that extra revenue. Yes, a lot of the bad news is front end loaded on this bill, but tariffs. You're missing the point of tariffs, and he'll push that. And I think it'll probably. I think that bill will probably get through. Reverse repo. 136 billion reserve sitting at 3.2. Let's throw the TGA in there. We'll start watching this because Besant had said by August we won't be able to pay our bills. That's about 90 days away. Let's say 562 billion. Let's keep our eye on that. Fed funds futures. Q2 pricing in only 3 basis points, which is this last meeting over here is basically saying, okay, there's nothing happening in Q2. But Q3 and Q4, 1 cut in each of those for 2 cuts. This is as per their last SEP. And on this one, we get a new SEP and a new dot plot. Will we still have 2 cuts in for the rest of the year? I think this committee is really falling victim to groupthink. They're all thinking the same thing. They're all looking at the same thing, and there's not enough independent thinkers in here saying, but guys, look at this AI stuff. Look at what's going on over here. Look at first quarter GDP. Shouldn't we be concerned about that? We're 150 basis points restrictive. Is that maybe too much? But I think you do have some level of groupthink, and you have a common enemy, the administration now, right? Q1 got another 21 basis points for 73 basis points over the next year, all the way to the end of Q1 of next year. For the October meeting, L means I'm long, P means I'm trying to get a position. So ZQ for October, I am long ZQ for October. There are 3 meetings before you get to October: June, July, and September. And it is pricing in basically one cut over the next 3 meetings. If you think, one, yeah, I'm sure they can squeeze in 1, then a long position there is low risk. What could happen? I don't make a single penny, but I won't lose anything, right? So I'm long. I'm not all done. I'm going to be adding to this, but I started my long position here. I want a position for the January. I didn't get it. 3.81. There are 2 more meetings between the October and the January ZQ. October and December, you have 2 more meetings. And then you have 2 more meetings before the April. You have January and March. I also am looking at the May. May has an implied rate of 3.56%. That's 3 cuts. 3 cuts in 8 meetings. Or should I say 77 basis points, because you're going from April to May, and you could see 96.40 and 96.44. So I added the other 4 basis points here. 77, which is 3 cuts in 8. So you have 8 meetings before May, 3 and 8. So I'm long May. I think I got it at 96.435. I was bidding at these at 95.895 and I got filled at 95.895. And I was trying to get these at 96.17. These ones here at 96.17. 96.17 it was printing 96.17.5 to 96.18 by the end of Friday, and I was saying, I'm not going to chase it. I'll let it come to me. I'll have more days to get this done. Okay, real yields. Look at this. May 14th, the 30-year real yield hit a cycle high of 2.65. Ended at 2.59. This got as high as 2.5. I think 2. It was a 2.49. Looked like it was going to take this one out as well, but it didn't. 2.43. We'll see what happens next week in terms of real yields. We are, if you look at the level of these yields, 2.59 on the 30-year, over 2% on the 10, the 20, 30. That is restrictive. So the long end of the curve, I think, really does need some work from the 10 outwards. Break evens climbed a little bit. We'll look at consumer sentiment and what the belief there is, and the break evens are nowhere near there. If we look at where we were at the beginning of the year, 2.38 sitting at 2.42, it's not too bad. 235 is at 237, 234, same thing on the 10-year, hasn't changed. The break even on the 10 is the same as it was January 1st. 245 to 249, even the 30, the break even on the 30 is the same as it was, and the 5-year forward is lower than it was at the beginning of the year. Mortgage sitting at 681. That's set to get worse. This downgrade is not going to lower yields. It's only going to raise yields. It'll lower prices, so that is set to get worse. Poor housing market, can't cut a break. Spreads, nothing to see here. Look at this, all of them contracting over the week. Let's see if I can get my pen to write here. There we go. Double A contracted by 10%. Double B by 11%. TLT, week over week, down 0.86, down another 1% after hours. It took all week to lose 0.86 and took just a couple hours to do more than that in a couple hours that it did all week. So ended the week down 1.9%. SPX 4.78%. Remember Monday? Yay, China. It lost 1% after hours. So if we consider the effect of the downgrade, up 3.78%, then the dollar index, we have no measure for it after the fact, up 0.75, up above 101. So let's just figure out what our basis point effect would be on the 20 to the 30. TLT after hours dropped 0.9 or 90 cents, which is 1.04%. Has an effective duration based on its term sheet of 15.61. So the percentage change in the value of whatever the portfolio is going to be negative effective duration times the change in yield, and we want to figure out change in yield. So we know the percentage change was 1.04. We know effective duration was 15.61. Solve for our unknown 9.23 basis points. That would put both the 20 and the 30-year above 5% if it did open. If TLT, the way it finished, was a good predictor of where yields would open, that would put the 20 and the 30-year both over 5%. Question is, does it put the 10-year over 4.5 and on a trajectory towards 5% on a growing narrative? What is it going to be? Will it be brushed off? Or will it be the dominant theme next week? Okay, let's revisit tariffs here. FactSet sent out on their email on Friday. Pretty good story about the number of companies citing tariffs on earnings call. This is a 10-year period. This was the last time that tariffs were announced. That's not a good color on white, right? There it is, 2018. Look at where it is now. Even the second highest, the last quarter was the second highest, way above there. Look at where it is now, well over 400. Here's the percent that are citing tariffs. Within consumer staples, 100%. 100% of them were citing tariffs. Within materials, 100% of them. Within real estate, 100% of them. And then it drops down the lowest, just sitting above 65%. Communication services, most of that is domestic. Energy, 73%. Consumer discretionary, sitting at, 84%. It's blurry, right? Financials are next. Information technology is here. But well over 400 of them, over 80% of them citing tariffs on their call. So it's a thing. It's got everybody talking. It's a thing. I mean, we knew it was a thing back here. And you had, at the peak there, 175 companies. Now you have over 400. So it's a thing. What do we have in terms of tariffs? What exists? Because it's hard to keep it straight, right? Right now, there is a 10% universal tariff in place. There are some exceptions to it, but it's a 10%. Every country's got a 10%. That went into effect April 5th. There's 25% on cars and parts, and of course some exceptions. The UK we know of, up to 100,000 cars, that only face the 10%. And anything that's USMCA compliant. This went into effect May 3rd, the 25% on cars and parts. 30% on Chinese imports, down from 145%. That happened May 13th. It dropped to 30%. There are some exceptions there as well. Not everything is 30%, some exceptions. And 25% on Mexico and Canada on goods that are not covered by the USMCA. Yes, there are some, but it's not a big amount. But yes, there are some. That's been there since March 4th. And of course, you do have some retaliatory tariffs from Canada as a result of that. That's what's in place so far. What has been paused? Reciprocal tariffs till July 8th. That is 51 days away, July 8th. So there's 7 weeks. We got to get through this week of probably the debt talks, and Bloomberg and CNBC, I'm sure, will have all their guests, as many as possible, talking about the yield curve and the debt, and that'll become a narrative. And then you got 6 weeks. 6 weeks until reciprocal tariffs are back on. Now, here is my thinking. I'm going to predict 2 things by July 8th. Tariffs will be higher than 10%. There'll be some reciprocal tariffs. We don't know what it'll be, but this 10%, that is a minimum. That's the opening ante on the table. Because when we get to the S&P chart, you're going to see that, it fell off, and you have a V-shaped recovery. All right back on with 10%. So the administration and Trump will say, look, this is what we got. We got 10% across the board. We got 25% on cars and parts, 30% on China, 25% on all of this. And the market is threatening new all-time highs. The market's just fine. They can handle more than 10%. They can handle more. They just needed more time. He's not done. He is not done. Because 10%, all of this here, is not enough to get balanced trade. It's not enough to really change the pattern of international trade. It's not enough. They're going to come to that conclusion as well, that it's not enough to really convince a big wave of investment into the U.S. so that there are no tariffs. They're going higher. They're going higher. They need the revenue. They need the revenue. It's going higher. You have that to look forward to. You got 7 weeks of calm before it starts going higher. And I don't want to be that guy, but I think I'm going to be that guy. I told you so. And once we get there and we see the new level of tariffs. The other thing I think they're going to do is announce a new Fed chair, because they need those yields to come down. Powell's not going to be much help. He's pretty much stated as much. We're in a good place. Monetary policy is in a good place. He said that many times. They're not going to bend to the will of this guy. And the more he presses, the more they're not going to, because they'll feel they're protecting the independence of the Fed. The best way to get this done is to announce a new Fed chair now, who then says, yes, we are very restrictive. Very restrictive, and the Fed does have a role to play in yield curve control. And that is how you can get it down if you can't get the FOMC on board with you, which I don't think you can. I see higher tariffs, and I see this probably happening at the same time. If you're going to introduce higher tariffs, you need somebody on the other side that's going to work in your favor to get that yield curve down. Those are two things I think that are happening that will come to pass. And you got 7 weeks to find out, right? Higher Chinese tariffs, August 12th. Remember, they were only delayed for 90 days. You got till August 12th. Now, beyond what is in place and what is just on pause, there are threats. Pharmaceuticals, semiconductors, lumber. Lumber is covered by the USMCA. Well, we don't need their lumber. We got to make semiconductors here. They're ripping us off. Copper. Move your copper mines to the U.S. I could just see them saying that. You got a copper mine in Indonesia, move it to the U.S. There won't be any tariffs on your copper. Movies produced outside the U.S. will face tariffs. So if you're going to film a rom-com in Paris with American director, American film crew, American actors, well, that's not produced in the US. You're going to have to pay a tariff on it, which means get ready for those old 1940s, 1950s type movies where Paris is on a movie set built inside a studio. No tariff. So I wonder if that's going to make movies worse than what they are or better than what they are. But tariffs are, these are threats. On top of what is paused, on top of what is there, on top of a market that just is rallying in bull market territory as of the close of 4 o'clock, and a Fed chair that's not going to come along. To put things in perspective here about trade, by the way, 20% of world output is traded. 80% of world output is local. 80% of it is local. Only 20% of world output is traded. This is as of the latest number that's available, which is 2023. 20% of the world output actually gets traded. All of this over 20%, and you're ignoring the 80% that is local. That is the bigger piece of the pie, the 80% that is local. So it seems to me like a colossal waste of energy and time engaging in these tariff wars. If you want balanced trade in the U.S., you must convince everyone to stop spending more than they're making. Because if you spend more than you make, you must have to buy the stuff from outside the country, because you have an identity that GDP equals GDI, gross national output, or gross domestic output equals gross domestic income. If you're going to spend more than you make, and if these two things are equal, then that means you're buying more than you produce. You got to import it. Balance the budget. There's $2 trillion right there. Oh, how big is your trade deficit? Look at that. Balance the budget. Balance the budget. There you go. You don't have to do any of this nonsense here. Just balance the budget. Okay, a couple of announcements from the AI world last week. Google's DeepMind. Remember they produced something called AlphaGo. Now it's Alpha Tensor here. Google's DeepMind, not Alpha Tensor, Alpha Evolve. Changed the name from AlphaGo, Alpha Evolve. Did something really incredible. Now I have been discovering AI's potential to really eliminate a lot of tasks. And I think there are 3 buckets that we can place AI in. This is the first one that we can put it in. Found an algorithm to multiply 4x4 complex valued matrices using 48 scalar multiplications, improving upon Strassen's 1969 algorithm that was previously known as the best in the setting. 1969. It's held for almost 60 years. And an algorithm beat it. This finding demonstrates a significant advance over our previous work, alpha tensor, which specialized in matrix multiplication algorithms, and for 4x4 matrices, only found improvements for binary arithmetic. So multiplying a 2x2 matrix requires 7 scalar multiplications. So if you square these two to create a 4x4, the idea is, well, you square that, you get 49 steps, and that's where you get the, let's see if we can write on this, that's where you get the 49. This was able to do it in 48, right? To investigate alpha evolved's breadth, we applied the system to over 50 open problems in mathematical analysis, geometry, combinatorics, and number theory. This gets scary. The system's flexibility enabled us to set up most experiments in a matter of hours. In roughly 75% of the cases, it rediscovered state-of-the-art solutions. It means, here's the problem, go, and it comes up as, well, that's the exact same solution. That is the solution to it. Look at this, 75%. 20% of the cases, alpha evolved improved the previously best known solutions, making progress on the corresponding open problems. For example, it advanced the kissing number problem. This is where you have a sphere. You have to think of it as three-dimensional here. And you figure out how many other spheres you can have, non-overlapping, on the surface of this sphere. That they're just touching each other and just touching the surface but non-overlapping. This geometric challenge has fascinated mathematicians for over 300 years and concerns the maximum number of non-overlapping spheres that touch a common unit sphere, non-overlapping. Alpha evolved discovered a configuration of 593 outer spheres and established a new lower bound in 11 dimensions. I think previous it was 12. Now a lower bound of 11 dimensions, 593 outer spheres. It is now going beyond what humans can do. And I think that is one area. Let's put that in bucket one. There's one area for AI, is that it will be used to do things that no humans are doing now. So that won't displace any jobs. It will actually create jobs, because you got to do something with the output. The output must lead to something, right? So if you can conceive of something and say, well, we can do this. And you may say, oh, come on, we'd need, how many people would we need to do it? And the output, the cost of getting it done doesn't justify what the value of the output is. But AI can now do it. So no jobs will be lost here. In fact, you may be able to create jobs. The second bucket is where a company can can increase its output for the same number of people and place that output in the marketplace. Here is where I think financial analysis falls. Is you have a team of, let's say, 5 analysts, and they may be covering 4 industries and 30 companies in those 4 industries. That if you wanted to cover 8 companies and 60 industries, you'd probably need 10 analysts. But maybe AI can get them to 8 industries and 60 companies with the same 5. So that nobody loses their job here, just the output increases, but nobody gets displaced. I think that's where financial analysis falls, is because coverage is expensive and limited. You can't cover everything, so you have to pick and choose. This will allow teams to increase their coverage. And if you can increase their coverage, well, that's good for sales, right? And then there's another group where output can be increased but cannot be placed in the market. Let's take automotive research. Let's say a company that has 40 analysts, they're covering the whole supply chain. There really isn't more to cover. They're covering everything that needs to be covered in that particular thing. AI will increase their output, but there is no output to increase because they're already covering everything. So what is it more likely to do? Cut their staff, right? So if they have the whole value chain already, we got everything covered. There's no point in saying increase the output, but we can do this. Instead of with 40, maybe we could do it with 32. This is where you're going to have job losses. So I think you're going to have some job gains in bucket number 1, where AI will now do things that we never bothered doing because it would be too expensive with humans. there'll be no job losses in bucket 2, only increases in output. Here you're going to have some job losses over here. I don't know which one's the bigger bucket. I'd say in the short term, this is the bigger bucket. In the short term, take a software company with 1,000 employees. I think basically with where the state of the field is right now with coding, you could probably easily get to 800. Give it 2 years, you could probably get to 500. Give it to 2030, you could probably get that done with 100. That whatever you're using 1,000 people for now, you probably by 2030 only need 100 to do. That I don't think is getting enough attention. Is just the potential for job losses in the near term before job gains can start to be realized. I think you're going to have some very real creative destruction. And this is a general purpose technology. This is one of the first technologies in which it's not a technology that kills a specific industry and creates a whole new industry. This is a technology that cuts across every single industry. And it's not like when we first introduced farm equipment, where you had laborers that could do so many acres a day, and then you gave them a tractor, and suddenly you could do more acres per day. This is not one of those things where if you put a tractor in a field but you have no humans, well, the tractor's useless. You still need a human. This is one of these very real things that if you put one of these in place, and AI agents will only get better, if you put one in place, you actually don't need a human. So it's not a matter of the human capital ratio where you're adding capital to humans. You're actually eliminating humans with the capital at this point. So I think there is going to be some creative destruction first. Who captures this? You have 4 buckets. You have the maker of the tool, whoever made the AI tool. You have the company that is going to use the AI tool. You have the employees within the company that are using the AI tool to be very productive. And you have the customer. I think the company is going to win. Definitely going to win because it can increase its margins or increase its sales. However, it doesn't get to keep 100% of all its gains. It's going to have to share some of it with some of its more productive employees. So they'll start to earn more and some employees will lose. The ones that lose their job, whatever income they had will be split between the company, who will now get to keep it. Some of that money will go towards the employee, and maybe the customer gets some of it passed on in cost savings or a better value proposition. This is where I have the question mark. I don't know if the tool makers actually will make money, considering the sheer amount of investment, the billions and billions of dollars of investment right now. Can they generate revenue faster than that technology depreciates? Because if you build a multi-billion-dollar reasoning model and another company comes out and their reasoning model is a major step above yours is obsolete. It means you got to spend billions of dollars to catch up with that one. And there are literally thousands of companies around the world producing models. Some are foundational models like the big LLMs, and then you have reasoning models that are built on top of that, and then you have domain-specific models that are built on top of those. I don't know who the winner in that space is going to be, but I do know companies that adopt it are going to be the winners. That I do know. Do they share it? How much of what they capture do they share with their employees? Do they share with their customers? And how much do they capture actually gets paid back to the tool provider? With so many different tool providers out there, I don't know that anyone is big enough to extract all of the value. I don't see an app store like AI provider where there's only one app store. And if you want your app in that app store, you pay 30% of whatever revenue it generates, period, end of story, see you later if you don't like it. I don't think that any one company is going to have that kind of market power. So I don't know that the companies will be able to extract much from the companies other than some competitive rate for their models. companies, I think, will be the big winners that have the ability to reduce their workforce or massively increase their output or create whole new things that never existed before because it was just too difficult to get done with humans. And then maybe the customer gets something out of that. Another thing that happened, Meta delayed Behemoth, which is their next model. Initially was scheduled for April release. Then it was delayed to June. Now it's going to be late fall. And that is after increasing their CapEx, 64 to 72 billion for 2025, up from 60 to 65 billion. Engineers having difficulty improving the model's capabilities. So why would you release a model that the whole market will benchmark and say, this is no better than the one you had? You're reaching your limits, aren't you? With all the companies that are out there, almost on a weekly basis, you have a new model hitting the market. The speed at which this is evolving is incredible. It is hard to keep up. If you just scan for news in this space, you get buried with headlines of this model, that model, this new thing, that new thing. It is absolutely incredible. And I don't think the Fed has this on their radar at the level that it should be. Okay, this is from JP Morgan Market Insights, May 12th, 2025. It just gives you a recap of a lot of interesting stuff and sort of a nice dashboard right away. Chart of the week. Look at this. This is 2025 consensus EPS growth estimate. Recall the last couple of weeks I said I don't recall a time when earnings fell this quickly outside of a recession. We're going to see that they fell again today, and again not by 20-30 cents. This gray line is S&P 500. This is earnings growth up to around 14%, and then this is January 25th, the beginning of February, just cratering. Right now down to 9.2 from over 14. This is the 493 just dropping off, and the 7, the Mag 7 still holding it up. Earnings growth 17.1%, but the 493 7% growth. Thought you might like to see that before we look at the S&P 500. Here we are. Forward 4-quarter operating earnings. 269.93 down from 270.96. These are big drops every week. I seem to think 260 is where it's going to bottom out. If it were 260, given the closing SPX, you'd be at 23 times forward earnings. So if we forecast ahead and say, well, we think it's going to be more 260, you've gone from 277 to 269 in 1, 2, 3, 4, 5 weeks. 5 weeks. Give it another 3, 4, 5 weeks. I think you're going to hit 260, which means this closing price puts us back at where we were over here, 23 times forward earnings. I can't wait to get in. Oh my God, the train is leaving the station. Take off 60 points because of after hours, 58.98. So I calculated 2 forward multiples. If we use the closing, we're over 22 times forward earnings, 22.07, up from 21. We added a full multiple because you had earnings drop while you had the market accelerate. Again, if we ignore the 60, almost 5% over the week, 22 times, and let me in. Look at this, all the way down and back up. These V-shaped recoveries we've seen for the last decade and a half. If we use after hours, we're still to almost 22 times, and that's with the effect of what happened after hours, still 22 times of the forward earning. Using the February 19th all-time high of 612 and the closing SPX, you're less than 3% from a new all-time high. Trump is going to look at that and say, see, they just got too nervous too soon. They can handle more. See, this is going to embolden them. After hours, you're still only 4% below an all-time high. Remember that list of tariffs I gave you that did not exist February 19th? did not exist. They exist now. And if we look at where the yield curve was February 19th to where it ended without the after hours stuff, it's about the same. It's pretty much about the same, a few basis points either way depending on what tenor you're looking at. But based on the after hour stuff, it is now, the yield curve is now higher than it was February 19th. Tariffs are higher than they were, and the emboldenedness of the administration is more than it was down here. Tariffs are working. Tariffs are raising revenue. The market is not concerned about the tariffs. S&P is concerned that we're not raising revenues. Let's raise tariffs. The market can handle it. IWM 209.85. This is this is the closing price, not after hours. After hours, it dropped to about 208, so it's still down 13%. IJR 108 is down 14%, and a triple Q is 3.5%. 3.5% below, and this dropped to, I think, 514, 513, 514 after hours. If we look at the lowest close on SPY was 490. Anything 20% above, if you climb 20% below your lowest price, you are officially in a bull market. So I just found the 20% price, 588.69. If you break 588.69, S&P is officially in a bull market. Ended at 524. 594. Even after hours, dropped to 588.25, 588.69, just below a bull market. IWM would have to be above 206.94 to be in a confirmed bull market. 209.85. Even after hours, it's still held above 206. IJR would have to be above 106.93, 108.49, and triple Qs would have to be above 492, 521. The small caps, the tech index, the large caps, all at 4 o'clock on Friday in confirmed bull markets. Just digest that for a moment. All in confirmed bull markets. Spitting distance, 2 of them in spitting distance from all-time highs. And just go back to that list of tariffs. Go back to the threats, what are being threatened on tariffs. Remember what Walmart says. Remember that the Fed is not really going to move, and add the downgrade to that. Does any of this actually seem like a logical outcome to you? It I think is just a lot of muscle memory that over the last 15 years we have trained the market really for V-shaped recoveries. There is no other type of recovery. If you look back 10 years, 15 years, and everything that's up, there is no other type of recovery at an index level other than a V-shaped recovery. So what K-shape? What L-shape? What U-shape? What W-shape? It's a V. It's always a V. And I think it's just muscle memory at this point. Implied volatility almost disappearing, 9%. That makes it hard to use zero-date expiration options with SPY because you need premium. Right? And the premium is disappearing, so it's becoming more expensive. So I will probably switch from using 0-day on SPY to using 0-day on IWM. Implied volatility is much higher there. Last week it was the 48th percentile, dropped all the way to the 9th percentile on its IV. What do we got next week? 17 versus 18, who cares, right? You know, they're never going to agree. Hatfields and McCoys here. Tuesday, Home Depot. Thursday, Dollar Tree. Given what Walmart said last week, I mean, they're in the best position to try to squeeze costs out of the system. Let's see what Dollar Tree has to say. Wednesday, you get Best Buy. You get Palo Alto Networks, Target, and Lowe's. So Target... following Walmart, let's see what they say. You have Home Depot, Best Buy, Lowe's, Dollar Tree, all in the retail space. Let's see if they follow Walmart. Let's see if that tone bleeds through. If they feel emboldened to say, listen, Walmart said they're going to increase prices. Well, We are not going to be called out for following through. If they follow through, along with the narrative of the downgrade, along with the Fed probability of no rate cut at the next meeting, I think you could look at the long end of that curve going up by more than 9 basis points. It could be an ugly week for duration next week. The big one is May 29th, NVIDIA. I do not see why their story would not continue. The question would be, how their margins come in, what their growth is, because they could be at the peak of their growth, and extra growth is hard to get, but what they have is not fading away. In which case, you could probably argue for a lower multiple, but probably not lower profitability. If anything takes them down, it will be their growth rate. I don't see that their sales would slip, or that this is ending at all. Not with the speed at which newer and newer models are coming out. You need to train all those newer models. I don't see this. I don't see that NVIDIA is going to signal that we're at the end of it. They may even signal that they're seeing an acceleration going forward. That this is still got years left to go. So I would be careful thinking NVIDIA is a short. Only if its growth rate can't come through. But where are you going to go in this space? It is the product to have. Anyways, there we are. We have a shortened trading week this week. Monday's closed. It's 10:22 a.m. now. Bitcoin is being read all weekend, so sort of suggesting risk off. We won't know until 6 o'clock, and even then, North America is closed. We're really not going to know much till Tuesday morning.